Are you a retiree who's concerned about taxes? You understand paying your fair share, but don't want to pay too much and put retirement at risk. Does the tax code confuse you? Does it feel like you need a secret tax decoder to understand all of it? You're not alone. On today's episode of Retirement Rescue Weekly, I'm going to teach you why it's not what you make, but what you keep. Stay tuned. Welcome to Retirement Rescue Weekly, where we throw a lifeline to your financial future. This podcast is dedicated to helping rescue retirees from potential dangers that appear in retirement. I'm Curt Arnold, your host and financial advocate. I'll guide you through the stormy seas of retirement. We'll tackle inflation, taxation, market volatility, and healthcare costs. Together, we'll secure your retirement. Tune in and start your rescue mission today. Well, thanks again for joining us for episode 2 of Retirement Rescue Weekly. It is a joy to be able to teach to you on a weekly basis. Today's topic is going to be taxes and how do we mitigate Uncle Sam in our retirement. Now, during the pandemic, I think back to all the people that I started meeting with that were really looking forward to trying to retire. They were getting burnt out. They were kind of sick of the commutes and were like, Curt, how do I retire? What do I need to know? What do I need to do? And one of the most common questions kept coming up was taxes. Curt, I don't understand taxes. My financial advisor never talked about taxes. My CPA isn't really talking much about this. What do I need to know? So I want to teach you today some things that you can do. And I would say starting now, think about and start implementing to make sure we can keep more of your hard-earned earnings. So let's get to the teaching for today. So again, we're trying to talk about how we can cut taxes, keep more of your hard-earned money. Now, Albert Einstein, brilliant mind, I love this quote because it's so appropriate, says, the hardest thing in the world is to understand the income tax. I would agree with you, Albert. It is a very difficult thing to understand. Now, on the screen, you'll see two different books, so to speak. The first one, the Bible, over 800,000 words. It's a task to read that. I've done it myself, but it's a lot. Now, the good thing about the Bible is it doesn't change frequently. Now, the one on the right, the tax code changes all the time, but over 4 million words. So one of the things I always joke with my clients in prospects when they come in to potentially meet with me is they say, hey, Curt, what do I need to know? And I say, did you do your homework last night? They say, what do you mean? I said, did you read the entire tax code? So we're ready to talk today. They look at me like, oh, no. I'm like, yeah, don't worry. I don't anticipate you would have. And in fact, a lot of people who write the tax code haven't read the tax code, so don't worry. But we're going to try to simplify it here for you today so you can understand what are some things that you need to know that can help you understand what you have to do for your tax planning. Now, on the screen, you're going to see a lot of different ways we get taxed. My dad used to joke growing up, there's two certainties in life, death and taxes. I think we all know what taxes are. Even my daughter knows what taxes are because when we went trick-or-treating one year, I said, hey, you got to pay the dad tax. You got to give me a portion of your candy. And so she even said, Dad, I don't like taxes. I think we can all agree we don't like that. And obviously there's lots of different ways we get taxed in this country, just the kind of the way it is. But the key is not getting taxed too much. So why is tax mitigation important? For retirees, we want to make sure we're not going into higher tax brackets and paying higher tax rates than we should. If we pay more than we should, then that just means less for us and more goes to Uncle Sam. The other thing we have to be worried about too is inflation and rising costs. We've seen that really recently, but obviously when you're kind of on a somewhat of a fixed income in retirement, we can't afford to have that pile of money that we're going to use for income at some point start dwindling away and eroding because of higher tax rates, because every time we touch certain parts of our money, it could be taxed. And then if it gets taxed at a higher rate, that means less for us and for our actual retirement. That does put longevity at a risk then too. If we start really taking out more and more money for income, and because we have to pay tax more, we're taking out actually more when we're doing that. And we're also taking it out at times where maybe the market isn't favorable. And when that happens, it actually causes it to go down further and faster. And then we also have to be aware of medical expenses because obviously as we age, baby boomers especially, they're all hitting retirement right now. And we know that there's going to be a new pandemic. And that meaning that there's going to be a lot of people retiring, a lot of people living longer. And that's going to be more of a stressor on our medical system because there'll be probably a lack of facilities and lack of workers. And that's going to actually cause those medical expenses to go up as well. So Some concerns we have to be aware of is don't ignore state tax exemptions. Yes, I know state of Florida is tax-free as far as state goes, but if you go to other states, if you move, you might have state taxes you have to think about. A lot of people do not understand what is an RMD. We're going to talk about what that is a little bit, required minimum distributions, and why you got to know what that is, and what that can actually do to your retirement. And a lot of people don't have tax diversification. They might have diversification in their portfolios, but they don't have tax diversification. Now, when you were working, we were all told when pensions went away, put money into a 401k. Everybody was told to do it. Hey, we can get that employer match to make it an incentive for you. Put it in there. When you do it, it lowers your taxable income, and then that's going to grow tax deferred. And then later on, when we take that out, we're going to probably be at a lower tax rate. So it'll work itself out. That's what we thought. However, things didn't quite work that way, as you'll see as we go through this today. So that is one of the things we have to be aware of as well. Now, what people don't realize too is your Social Security does get taxed, and it does depend on a provisional income calculation, which we'll talk about in another episode. But these parts of the tax code do impact Social Security. So we have to be aware of that. And when I tell people you're going to get taxed on Social Security, they get really upset about that because like I didn't know that. That's not right. That's not fair. I've actually had people even bang their hands on my table and they're upset. Then another thing that people aren't aware of is Medicare premiums can go up because of your taxable income, and we call this Aunt Irma, which is a friend of Uncle Sam. Aunt Irma, income related monthly adjustment amount, which basically means as your income gets higher, you can actually end up having to pay higher Part B and Part D Medicare premiums just because your income's higher. So sometimes this can happen on a one-time event, or it could happen for the rest of our retirement if we're not careful. And then you end up paying quite a bit more in Medicare because of that. And if you're already a giving type of person where you're giving to your local church or schools or organizations, if we're not doing that in the right way, we actually lose some tax advantages from not doing it in the right way as well. So we have to be aware of that. So one of the things we always ask people is, do you feel that taxes are high or low today? And usually it's consensus that people feel they're high today. And when you look into history, which we'll do in a little bit, we'll actually see it in comparison to historical. We're not doing too bad now, but it just feels like it's really high. And before we get to our next segment, I wanted to share this because this is kind of a common thing. When people come to see me, oftentimes they're not getting help on tax planning, or maybe they just don't know where to start. And they're like this guy. I have no idea how taxes work. At this point, I'm too afraid to ask. I've actually had this exact scenario in my office several times. I totally understand how he feels. There are many people like that. They're just afraid to speak up because they don't know what they don't know. And unfortunately, they're hoping like it just works itself out, but it also can have some disaster if you're not prepared. So with that being said, let's take out our secret decoders. Let's figure out what the tax code is all about so we can understand how that applies to our retirement. To understand our tax code, let's go to the IRS. And let's remember there are 3 different tax buckets to understand: taxable, tax deferred, and tax-free. Our first bucket is the taxable or non-qualified bucket. Now this bucket is related to capital gains. Based on how long you hold an investment for, whether it's less than 1 year in terms of short-term gains or more than 1 year in terms of long-term capital gains, that will determine how you're taxed when you sell an asset. Now think of it like a pie. Uncle Sam's going to take a piece of that pie based on how well it grows. Let's take a look at a real life example. Let's say you had 2 different types of stocks. The first stock you sold ended up having a $2,000 gain, and the other stock you sold ended up having a $1,000 loss. Now at the end of the year, those will get reconciled and you'll end up having a net $1,000 gain. President Biden and other politicians have looked at increasing this rate, so something to be aware of in the future, but right now it's more favorable. So 0, 15, and 20% based on your tax filing status. Now let's pivot to bucket number 2, or tax deferred. This is the most common one you're going to see in our country, as many of us were told for years to put money into your employer retirement retirement plan, a 401k, 403b, 457, and then oftentimes people will have IRAs if they leave those employers. Now, how does this bucket work? Well, essentially, as you're making contributions in this bucket, you're lowering your taxable income, which is actually effectively lowering your taxes while you're working, with the thought process then being when you get to retirement, your income would be lower, thus your taxes will be lower. So you're essentially kicking the can down the road on taxes, saying that I'll pay those taxes later on when I feel my taxes will be lower. Now, will they be lower or not? That does remain to be the question. And what's happened for a lot of people we meet with is that it's becoming a surprise where now their taxes are higher than they anticipated. And now those taxes and their taxable income are going up, and it's causing quite a bit of surprise. Now, every time they take money out of this bucket, they're taxed at their current tax rates, and it's counted as income. Now, when this happens, it does have other impacts. It can cause Social Security to get taxed more. It can cause Medicare to go up too, based on how much you're taking out and when. And you might have heard other people talk about those things called RMDs. Required minimum distributions means beginning at age 73 or 75, if you have not already started, that's when you have to start taking money out of those tax deferred accounts, even if you don't need to, because now the IRS wants to start collecting taxes. Now, we'll get into RMDs in much more detail in a future episode, but one thing to know is as that money comes out, it's going to add as income. So as your income goes up, you can understand then that can cause you to move up tax brackets. Now, a lot of people, when they put money into those tax deferred accounts, they weren't thinking they're going to have more income or higher taxes in retirement. They were thinking the opposite. But what's happening is now, obviously, who controls the tax rates in this bucket? IRS does. So we don't have control here. And right now, as you can see, our national debt is at all-time highs, and it keeps getting bigger and bigger. One thing that's very likely to happen is they could increase taxes to help offset the debt that we have going on. And if they increase taxes, that means whenever you take money out, you're going to be taxed at a higher rate, which means less to you and more to Uncle Sam. Now, if you're a person that has a pension, Social Security, and maybe your income is covered, you might say, hey, well, I don't need this money. Doesn't matter. You have to take it out anyways. And that's when it can really start to blow things up, because you start getting higher taxes then. And if you're paying higher taxes, that means more goes to Uncle Sam, less goes to you in your retirement, less goes to your family if you want to leave a legacy behind. So it's very important that you have a good plan in place to mitigate taxes, especially in this bucket. All right, let's look at the last of the three buckets for the tax code. That is the tax-free bucket, also known as the money that's already been taxed. So if you decide to pay tax earlier in life in different ways, that money grows tax-free, it comes out tax-free, it's the best of the best. You have control over this bucket. This is the bucket that will never be taxed again for you or for your relatives or family. Roth IRAs, Roth 401ks, HSAs, health savings accounts, 529 plans, things like that. All right. Well, hopefully that helped clears things up a little bit. I know there's a lot more we can actually talk about, but I just wanted to give a quick look at, again, the three key tax buckets and what that means as far as how you get taxed. Now, before we go forward, let's take a look at historical as far as how the tax brackets are. Going back to 1913, you can kind of see where the tax rates were. And then they kind of rose. The highest they ever were was in the 1940s and 1950s. They got to as high as 90 and 94%. Now you're like, well, how did that happen? How are they so high? Now, remember, our national debt was much, much lower then, too. Now, back then, there was a famous actor who did 2 films a year. The actor was Ronald Reagan. Now, he did 2 films a year, and the reason why is because he got paid $100,000 per film, $200,000 of income per year. They asked him, why didn't you do more than that? Why didn't you do more films? Because he could have certainly done more. And he said, well, if I would have done more, the rest of my income would have went to the state of California, because he was already at the top of that tax bracket. So doesn't mean we're going to be at that level now, but we have to be aware that they could be higher. And then if you go back to the 70s, they were at 70%. And then, of course, today the highest is at 37%. Those rates are going to go up just a smidge in 2026 when the Tax Cut and Job Act changes, which we'll talk about in a moment. But we do have to be aware that any moment in time, as you saw with our national debt being 35 trillion and counting, it's very possible they could start increasing these, and even a minimal increase of 2 to 5% is a big impact for retirees. So we have to be aware of that. These are our current tax brackets. Again, our single filing, our married filing jointlies. This is progressive tax brackets, so each dollar is taxed at these levels. But that's, again, where you have to be aware of as we start adding like RMDs, required minimum distributions, things like that. That's where you could start moving down these tax brackets pretty quickly. Now, we talked about the Tax Cut and Job Acts that are going to go away. They're going to sunset in 2026. So what does that happen then? So what happens is this 10% bracket becomes 12, 12 becomes 15, 22 becomes 25, 24 becomes 28, so on and so forth. Now, I don't know if you remember the old department store 80s and 90s called Kmart. They used to have a blue light special aisle, whatever. There's a sale for a limited time. There is a sale on taxes for a limited time. We know that we can save on tax if we decide to, and we can make a decision that we want to pay some of that tax now rather than paying it later. And I'll talk more about that in future episodes as well. But we have to know we can decide how much we want to pay tax on some of our tax deferred dollars. Now, the other thing that's going to happen too in 2026 is the standard deduction is going to decrease to what it was in the pre-Tax Cut and Job Act era. So what that means immediately on day one is you're going to actually have more taxable income just because the standard deduction is going to go down. So now we might have to go back to itemizing. And if we don't have anything itemized, which a lot of times retirees don't have that, now we might just have more taxes just because of that as well. So let's take a look at a case study. This is actually a real life example of a couple that I worked with a couple of years ago. They came to me and they were actually looking to retire. And they said, Curt, we're getting to the end here. We want to know, where is the end? How can we retire? What do we have to do? I don't even know how to retire. So tell us what we can do. So Richard and Nancy, they were in their late 60s, came to me and said, hey, when can I retire? When is it? And Nancy was really, adamant about wanting to retire soon. She was a nurse and she worked during the pandemic, so she was getting burnt out. Richard was more willing to keep working because he liked his job, was making good money. They didn't know anything about RMDs though. They were a couple of years away from RMD age, and they didn't know what do we need to do with that, or how's that even work. They didn't know how much Social Security was going to get taxed. They were going to be facing IRMA because their income was so high, and they're like, "What's IRMA? What does that have to do with us?" And they were actually pretty upset to learn about this because, like, why didn't we know about this? And then one of their biggest goals was they want to make sure that they can leave some money behind for their son and daughter. It was a really important goal of theirs. And they were worried that Uncle Sam and Aunt Irma were going to take too much of that. So we had to get together and we had to figure out a way to help them, rescue them from these different things. So let's take a look at what they had concerns about. So they said, I need $6,000 a month of income. Now, between the two of them, when both Social Securities were started, they're going to have $7,600 a month of income from Social Security. And you might be like, well, they're fine. For a while, they are just on Social Security, yes. But then with inflation and everything, then eventually they would need more income. Well, she also has a pension, so they're fine. So they have over $10,000 of income, $11,000 actually. So they're fine. The problem is they have an income problem. They have too much income. Now, what's happening down here is here's our investments. They have $1.5 million in tax deferred. This is money that's going to have to start coming out in 4 years. It's going to be a significant amount too. It's going to get added on top of their income that's already a lot of income. And then they have these other assets as well. Very good that they started getting money in tax-free. But right now, this is the part that's really going to blow things up, because as they go further in retirement, they're going to start moving down the tax map further and further into higher tax rates. And so they're like, well, what do I do? How can you save me from these higher taxes? What can we do? So I did a tax map to kind of show them the journey first and said, okay, currently you're at 24%. You only need, based on what you actually need to live off, is really only 12%, which will become 15 in 2026. But when those RMBs start, which is very soon, you're going to jump up to 28%. So the opportunity is, can I pay at 12 or 15 instead of 28? Yeah, you can. Now, as they continue going on and as those RMDs start ramping up, it's really going to start really push them into higher brackets pretty fast, because that's extra income that they have to deal with. Now, when one of them passes, which is what happens with life, they go to single filing tax status. And when that happens, that's that surviving spouse, which in this case we said, hey, what if it's Nancy? And I would show, hey, Nancy's going to be playing bridge with the ladies, but she's going to be paying a lot of taxes. So she's going to be complaining about taxes as she's playing bridge. And that's where we have to think about tax planning too, is how do we help her to also not have to pay too much in taxes? So again, there's enough for her to live out her retirement comfortably, but then also leave money behind for the kids. So one of the visuals I always kind of give people is the rearview mirror and the windshield. The rearview mirror, it's where you look backwards. Windshield's bigger because we're looking forward. And what a lot of people do is they wrongly blame CPAs and say, well, why did my CPA go over this kind of stuff with me? Well, the CPA is actually looking backwards 12 months. They're reconciling what's already happened during that 12-month period, and they're trying to file it for tax compliance and accuracy. And they're going to try to maximize it too, to give you as much a return as they can, but they're looking backwards 12 months. So they're a little limited. Now, what we do, I'm looking forward. I'm looking down the road and saying, what's coming down the road we have to be aware of? What is the current tax laws and tax code? Where are they potentially going? Are they increasing it? Does it have an impact on you? When RMDs start, when Social Security starts, when pension starts, where are we going to be on the tax map? And is there things we can do now before we get to that point down the road and actually save on taxes? And remember, we tip our waiters, we don't tip the IRS. So if there's some things we can do now, we should do it now. So what are some things that we can do for tax mitigation? Well, for Richard and Nancy, we had to start doing some Roth conversions, which we'll get into that more in a future episode as well. But essentially what we're doing is we're deciding to pay taxes now rather than later. So we're going to decide where do we want to fill our tax bracket at and pay tax on that and move that over from the tax deferred to the tax free. We also have to make sure that while we're still working, that we're being efficient with our investment strategies, that we're not creating a bigger tax problem. So we don't want to just continue to add more tax down the road. We have to make sure we're being efficient. And then also in that taxable bucket, which is another place we get taxed, we got to make sure we're not being inefficient there as well. But one of the things I see a lot of times is, and there's other major firms across the country that do this, they use the wrong investment vehicle in the taxable bucket. And that happened in this particular situation as well. They were using mutual funds in a taxable bucket. What's wrong with that, Curt? Well, mutual funds are actively managed by mutual fund managers, and they're going to actively change the investments throughout the year to try to maximize the return for you. Now, you may never, ever touch that account. You may let it sit the entire year. But at the end of the year, you're going to get a capital gain at the end of the year based on what that particular account did. Now, if you think about 2021, those accounts were down 20% a lot of the places because the market was down. A lot of people were down, but then they got a tax bill at the end of the year because of the capital gains from those as well. So that's a tax inefficiency that we have to be aware of. Again, if you're still working too, we have to make sure that we're maximizing HSAs, because we know that medical expenses will be one of those big things that we have to deal with when we get into retirement as well. So what can we do right now? Right now, it's extremely important that you're taking time to evaluate your current tax situation. Where are you right now? Where are things going as far as your investment portfolio and your income? And what can you do right now about any of that? And you need to consult with a tax planner, someone like me who is going to be talking tax with you and be looking forward with you to help you understand how you can minimize tax as much as possible. Now, one of the ways we're going to do that is we're going to explore proactive tax planning opportunities as far as, do we pay now or do we pay later? And it's not the same for everybody. So make sure you understand that each person's different, but we have to make sure we minimize Uncle Sam and keep more of that for you. We also have to review your investment portfolio for any inefficiencies, which I kind of just mentioned on the previous slide. We also have to make sure that we're looking at other inefficiencies as well, because tax drag, obviously over time, is going to have an impact on how much you actually can grow as well. And we have to make sure we are finding other inefficiencies in tax to make sure you can minimize that. And if you are giving, we have to make sure we are aware of that and we can do it the right way so we can take advantage of those different laws that are out there. There's a lot of tax laws out there that people aren't even aware of, but there's some tax laws out there that will actually help you if you want to give to charity and help you with your taxes as well. Now, one of the things we want to do is to make sure we're giving back. Today, my goal was to teach you about tax. And I know it's a lot of information in about 20 minutes, and there's no way you're going to be able to get all this in 20 minutes. That's fine. The second part of this, though, is what we would like to offer is a complimentary tax map. Now, what does that mean? It means I have to get some information from you just to be able to create that map. So we want to know, like, what kind of income do you need in retirement? What are your expenses? And then, roughly what do you have in those different parts of the tax code, tax deferred, taxable, tax free. So we can kind of start looking forward and saying, where are your taxes going? And is there some places where there's some opportunity right now to take advantage of that? There'll be a link in the show notes to get some information to get started on that tax map. So take a look for that and be more than glad to kind of give you some feedback on your particular tax situation and see if there's some things we can rescue for you as well. So that will wrap up our tax episode. And again, I know there's a lot of information, but I really appreciate you sticking with it. If you have some free time, go ahead and read the entire tax code. It's only 4 million words, and it'll probably change by the time you get through part of it anyway. So, but we're here to help. I'm passionate about tax because I know how frustrating it is for some people to try to understand this. I've had so many people sit across me and say, Curt, I just don't get this. I totally get it. That's why I study this stuff, so I can help you through this. We're here to help rescue you from higher taxes and make sure that your retirement is going to be more comfortable for you, so you don't have to worry about all these other things that are going on. So again, thank you for joining us. Join us again next Thursday live at 11 a.m. Eastern Time, 8 o'clock on the West Coast for more ways to help rescue you from your retirement. Thank you.